So what has happened to GE? In case you haven't seen it, GE has been struggling. Here's a chart of GE going back to 2016, and here's that same chart, but this time with the S&P 500 in there as well. Yeah, it's been bad. So the question is, what happened, and where's it going to go from here? So in this video, I'm going to go through the research I've done on GE to see if GE fits as an investment in my portfolio. If you like these types of videos, hit the subscribe button, as I'm planning to do a lot more videos just like this one going forward. Since I'm an analyst by profession, you may notice that I often let the numbers tell the story for me. But in this case, I was actually interested to understand how GE got into this amazing mess. So for this video, I'm going to go back a little bit further. Well, in 1981, Jack Welch took over as CEO. Then the company was worth about $14 billion, and by the time he left in 2001, it was worth more than $400 billion. Then Welch resigned, and he handed the reins over to Jeffrey Immelt. Now, there's been a debate as to who's to blame for the recent troubles of GE. Some say Welch handed Immelt a company that had drifted away from its history of inventions and innovations and became too reliant on GE Capital. A quick side note, GE Capital was actually started in the Great Depression and was instituted as a way to help struggling families pay for their refrigerators and other appliances. But by the time Welch left, GE Capital was driving a good portion of their almost $17 billion in profit. Meanwhile, GE as a whole was cutting staff, reducing research and development, and focusing mostly on building GE Capital, which had invested in everything from mortgages to credit cards to insurance and aircraft leasing. Well then, Immelt steps in, and perhaps he was trying to keep up with the legend of Jack Welch, but he made a series of acquisitions, many of which GE overpaid for, and they haven't provided the upside that GE investors hoped that they would, and that they believed that they would based on what they were being told. My goal as a potential investor and as an analyst is to try to understand where the company is today and where it will go over the next few years. So let's fast forward a bit to the more recent history. In 2014, GE bought Alstom Power for almost $11 billion and turned it into GE Power. In 2016, they combined their oil and gas business with Baker Hughes. Well, since then, GE has announced that they will be separating from Baker Hughes in what they call an orderly separation. They're also spinning off GE Healthcare to become a standalone company. GE Healthcare currently contributes about $19 billion in revenue during 2017, and that was about 16% of overall revenue. So now, GE's new CEO, John Flannery, took over after Immelt left. He says GE is going to focus on 3 segments: aviation, power, and renewable energy. He also says they're going to reduce net debt by about $25 billion, maintain a higher cash balance, and reduce their use of commercial paper by the year 2020. GE uses commercial paper quite a lot. Commercial paper is short-term borrowings that will usually be paid back in less than 6 months. Companies use it because they typically get a good interest rate, and since it's short-term debt and it counts as a money market investment, they don't have to register with the SEC. Now, commercial paper can be used to finance short-term expenses like inventories and things like that. So why is this important? Well, back in the Great Recession, GE had a ton of commercial paper, and it was using it to keep its operations rolling smoothly. And as long as commercial paper was available, GE seemed to be doing fine. Well, then the financial crisis hits, short-term commercial paper dries up really fast, and suddenly GE is in trouble. Warren Buffett steps in and cuts a deal for Berkshire Hathaway, giving GE about $3 billion in cash for preferred shares. GE raises another $15 billion more from an equity offering, and the federal government steps in and guarantees about $140 billion in loans. GE survives. Well, today, GE's bonds have been downgraded multiple times. Moody's currently has them up at A2. They started up here at AAA when Immelt took over, and now they're down here. If credit rating agencies keep downgrading GE, which they've already done 5 times since 2009, this will hurt GE's ability to raise short-term financing. If nothing else, it'll at least make it more expensive for them. So let's imagine that Flannery can pull off everything he said he's going to do. Let's imagine he can pull it all off. should we buy the stock here? Well, the real question is, what's the company worth? Let's take a deeper dive into our analysis and see what the numbers tell us. So let's try to calculate what the company could be worth, assuming that there are no more major bombs dropped. So I've done some research as to what other analysts are saying and as to what the company is saying, and here's what I've come up with. This table shows the past 6 years of actual revenue results for aviation, power, and renewables. To project forward, I found what I could from different analysts and came up with some growth rates for each segment all the way through 2020. I assume aviation will grow at about 6% a year. Power won't grow at all since they've had some competition come in on some of their major products recently, and it looks like this segment is struggling. We saw the first signs of the struggle last year when revenue pulled back in that segment. So here I presume a 0% growth rate. And frankly, I may be being a bit optimistic with that growth rate. For renewables, I have a 10% growth rate. I believe this 10% growth rate is possible, but it's also coming off of a smaller base of just about $12 billion in revenue. Next, I convert these revenue projections into profit. For both aviation and renewables, I used current profit margins and I upped the power segment profit margins from about 6% to 8%, based on some cost cutting that they say they're trying to do. And since it looks like GE as a business could stabilize by, let's say, about 2020, I went and found some competitors and looked to see what consensus estimates were on 2020 PE ratios. I found that if I use a PE ratio of about 15 times, it'll be a reasonable estimation. So my calculations here give me a result for a 2020 market cap of about $140 billion versus today's $120 billion. That would be a price of about $16 a share. Now, this ignores the healthcare segment, which is being spun out, and investors are going to end up with their shares of that new company. This is not insignificant since healthcare is a strong part of GE's business, and it's currently got about $20 billion in revenue on its own. If we apply a simple 3 times price to sales ratio on their $20 billion in revenue, that would mean that the healthcare segment would be valued at about $60 billion. If we add that $60 billion to our $140 billion, that would give us a projected market cap of about $200 billion, which is about $23 per share. Now, since I used 2020 numbers before for the 3 main segments, and I used last year's revenue for the healthcare segment, it's actually not correct for me to simply add the two together. What I should do is project out revenue for the healthcare segment and apply the appropriate multiple to that future number. But since I expect revenue to grow for the healthcare segment, it would be unfair to use a $20 billion revenue number since it would be higher in 2020. But you wouldn't use a 3 times multiple, which is what they're using on this year's earnings. So the multiple would be smaller, the revenue would be higher. But by this point in my research process, I'm fairly confident with what my decision already is, and I'm not sure that the difference in those numbers is going to make that much of a difference to me. So ultimately, after all my research, here's the reason I can't invest in GE right now. GE Capital is still around, they're loaded with debt, and I believe that will be a drag on the company until they figure out what they could do with it. Flannery has already said that the healthcare spinoff may come with a decent amount of debt attached to it, or perhaps a piece of GE's large, underfunded pension obligation, which would lower its value. GE's credit rating is lower, so capital is going to be more expensive. They may need to dilute investors by issuing more shares, which is one of those things that I think they might have to do if they're going to try to raise $30 or $40 billion to clean up the balance sheet. And since many of the acquisitions didn't shake out the way they expected, well then I wouldn't be surprised if future goodwill impairments would likely hurt earnings going forward. So at the end of the day, my concern here is that there are far too many assumptions that have to go perfectly for GE for this to work out. They need to clean up their balance sheet, raise more cash, keep their credit rating from sliding further, prevent good employees from jumping ship. They need to properly utilize good assets and grow the business while spinning off or selling any bad assets that they have. Meanwhile, there are a few things that could send this stock price lower rather easily. Another dividend cut, a hard no from Warren Buffett, a hiccup in the Baker Hughes deal, which is the oil and gas segment, or even a problem with the healthcare spinoff. If they announce there's going to be more debt there, that could be an issue for that company going forward. On a personal note, I got my first job out of college as an analyst at a hedge fund in 2005. And one of the first sayings that I heard was, "Don't try to catch a falling knife." Another one that means a similar thing was don't fight the tape. And basically, the lesson with these was don't try to time the bottom, or even the top for that matter. Right now, GE is trading at about $14 a share. And as silly as this sounds, I would rather buy the stock at $18 or $19 a share after they straighten this mess out and ride the stock to $25 or $30, because it's also possible that there's another bomb to drop. Maybe Flannery isn't the right guy for the job. Maybe GE Capital is worse than people thought. My point is that this may be the bottom, but it may not be the bottom. I may repeat this analysis in a year and find out that GE is now trading at $8 or $9 a share, and it looks like their house is starting to get in order. And if in the meantime, GE spins off GE Healthcare, and I really love that company based on a separate analysis of just that company, well then I can go out and buy those shares then. I don't have to jump in now and risk my hard-earned money on a company that has 1,000 question marks attached to it. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.